국내 주식 실시간 정보, 야간 미국 주식 브리핑, 전부 무료. 영상 아래 링크 클릭하고 그로스 리서치 텔레그램으로 들어오세요.
Hello everyone and welcome back to Growth Research. Today we are joined by Eric Jackson, founder of Toronto-based hedge fund EMJ Capital. Eric is widely recognized for his eye for high-growth companies, spotting Alibaba before it went public, predicting Satya Nadella's rise at Microsoft, and investing early in multi-baggers like Roku or Carvana and Coinbase. We'll discuss his investment philosophy, how he uses AI in stock picking, and dive into some of his favorite ideas today, especially Opendoor. Eric, could you start by giving us a quick introduction to EMJ Capital and your investment approach?
Sure. Thank you for having me. We've decided have a technology focus at the fund, and we're really trying to bring a venture capital kind of a mindset to public equities. And what I mean by that is that in the venture capital world, oftentimes you hear of something called the power law, which is that sometimes the most successful venture capital firms, out of 10 investments, 2 of the 10 will be what in baseball terms home runs, whereas you might have 4 that are maybe singles and doubles, and then you have another 3 or 4 that are actually money losers, and in some cases you might lose all of the investment initially. And yet, for the most successful venture capital firms in the world, those 2 out of 10 investments that do so well, and they are the home runs, more than make up for the losses or the average returns from the rest of the portfolio. And so in public markets, usually funds tend to focus on the singles and doubles, the more kind of predictable returns. The Mag 7s obviously have been very popular in the last few years. At EMJ Capital, we're trying to look past the Mag 7 names, even though they're great companies and we respect them and we think that they will continue to be very successful in the future. And we're more interested in trying to find the stocks that are smaller today, maybe in the $0 to $10 billion market cap range, that we think have the chance over the next 5 years of growing 10 times, 50 times, or even 100 times. And so probably the best example is in the recent years is Carvana. In 2 years ago, Carvana was a very successful growth company in America. They were trying to create a new way of buying used cars in America that disrupted the traditional car dealerships, and instead allowed consumers to buy cars directly from Carvana itself. They were very successful in the early days when interest rates were low. They were encouraged by the capital markets to pursue growth over profitability, and everything was going great until the interest rates obviously started rising significantly. And then suddenly Carvana saw its stock price drop from $400 to as low as $3 in December 2022. And when that happened, many people believed that Carvana would file for bankruptcy because they had a lot of high debt. And yet they had a management team that was very committed. They had a path to, they switched to a focus on profitability instead of growth. And they have managed now to come back from $3 back to $400 again, which has amazed a lot of people. I knew the company and had researched the company, and we had AI models that identified the company at $11 when it was starting to come back. We invested at $15. We enjoyed like most of the recovery, and it ended up being very, a big surprise to many people. And now we're trying to replicate that example and look for all kinds of new companies that are not well known today, but we think have the potential to grow again 10 times, 50 times, 100 times. And we want to buy them early, hold them, and not trade them because often these companies are very volatile. You have to be patient with them, and if you are, assuming you find the right companies, these are the ones that can enjoy something like 50, 100x returns.
What qualities do you look for in those kinds of opportunities?
Well, usually the ones that grow the most, like there are two types. One type is like Carvana, where it's I call it the Walking Dead stocks. And so they were successful once, and suddenly there are concerns about the company and whether it's going to survive, and there's a sharp drop in the stock price. And sometimes that the drop lasts for years. Like you might, like in the case of Carvana or Opendoor, it could be several years that the stock stays low. And so when that happens, being a public company, Wall Street loses interest, investors sell, they lose interest, and people stop paying attention to these companies. They assume that the companies will die. And so there are a set of factors that you need to look for signs of life, signs of, these companies coming back to life. And so, signs of such as, obviously, proof of profitability, proof that they've turned the corner because they go from being money losing companies often to steady profitable companies. There are some signs that you can look for, just technical features like shifts in the volume of how much stock trades in these companies that might show signs of seller exhaustion, and therefore like all the sellers have finally left and now the company is ready to finally see new buyers come. So there are things like that, and then you obviously have to judge the operational, the fundamental factors that tell you that the turnaround is going well. The second type of company is just like it's not the Walking Dead. It's more of the never discovered companies. So these would be like very small stocks, very low market cap. They've never been successful before. They might trade on smaller exchanges like in Canada or I don't know, Korea, and they're not in America, and therefore they're not as well known. And so for those companies, it's more of is there evidence that there's a real business here? This is not just an early company that's too early, but it has the potential to become a very significant player. So we look for both of those two types.
We've seen you talk about Opendoor many times on that American broadcast like with CNBC and Bloomberg. Recently, we also noticed your campaign on X encouraging people to buy Opendoor. Here in Korea, the number of investors trading US equities has grown significantly recently. However, most are still focused on Magnificent Seven, and many don't really know how much about Opendoor yet. I assume you've been asked this question many times before, but could you briefly share your core investment insight on Opendoor for our viewers?
Sure, it's a very similar story to Carvana. So Carvana was trying to use e-commerce to disrupt the way that people buy and sell used cars. Opendoor is trying to use e-commerce to disrupt the way people buy and sell their homes in America, and that's a very large market. So it's a $20 trillion the U.S. Residential real estate market today, and out of that $20 trillion, 14 trillion of those dollars are connected to mortgages that are tied back to those homes. And so Opendoor is basically they're trying to disrupt the traditional real estate agent. So these are people that go around, show you homes, and then go to a few open houses, and then maybe 6 weeks later they expect to be paid 6% commission. So it could be something like $35,000 for 2 or 3 open houses on the weekend. It doesn't seem like always the case that they've put in the work to justify such a high commission. But that's the way that the traditional world has developed. Opendoor is trying to disrupt that and to deal directly with consumers who want to sell their homes. And in America, some people need to sell their homes at certain points because they need speed, and they need certainty around the pricing of like what they will receive for their home, because they have bills to pay, or certain financial needs, the obligations that they have to pay. And it depends on the part of the United States where you live, but sometimes the real estate markets can be very slow if you take the traditional path, and you might be waiting 6 months before you finally get an acceptable offer for your house. So there is a need for a service like an Opendoor out there. Now they have had some problems though. It's a company that's been around for more than 10 years, and they were trying to grow quickly like Carvana, but they in order to execute their business model, they actually were the ones that would buy these houses from customers who came to them. And they ended up buying too many houses in 2020 and 2021 before the real estate market crashed. And so they ended up owning a significant number of houses that were, they paid more than what the prices dropped to. And so they ended up selling them at a loss, and the company went through a difficult time at the end of 2022. They've now cleaned things up, and they finally had their first quarter that was EBITDA positive in 3 years. And so right now, we're also in the United States preparing for interest rates to drop. We don't know when that will happen. We might find out in a few hours when Jay Powell speaks at the Jackson Hole conference. But most people expect that sometime this fall, that the Federal Reserve in the United States will drop interest rates, maybe a couple of times. And when that happens, that should help the U.S. housing market, which has been very frozen for the last 2 years. And as there starts to be more activity, that's when a company like Opendoor makes more money. So the cuts that they've made, they've eliminated some employees. They're a more efficient company now than they were 2 years ago. They should be a much more profitable company going forward, especially when those cuts come. And so for an investor like me, I see them, if we think of the Carvana example, they went from 400 to 3 and now back to 400. Right at this moment, I think you have the opportunity to invest in an Opendoor if you missed Carvana. It's not quite at $3 the way Carvana, the bottom for Carvana, but it's like buying Carvana at, say, I don't know, $8, $9. So I think it's a very good opportunity, and I think that's part of the reason why there's been so much interest from retail investors, not only in Korea but around the world, who say, "I missed my opportunity with Carvana. I wasn't paying attention, but I'm not going to miss this opportunity with Opendoor." And so every day I get new messages from investors in different countries. So today I got messages from the U.S. Virgin Islands and the Caribbean. I got two from Nepal, one the other day from Afghanistan, some from Malaysia, Singapore, a lot, probably more from Korea than anywhere else. I think that country, is probably number one in terms of the interest. But it's all over the world: Africa, Australia, New Zealand, South America. So it's funny because today Opendoor only operates in the United States, and yet I hear from people in these different countries, and they say, "When is Opendoor going to come to our country? We're tired of the local real estate monopoly. here. Like it's too expensive to buy and sell homes. We need somebody like an Open Door that's going to lower the cost. So I think they will follow a path similar to Uber, where Uber, had to deal with government regulations in the United States. It took a few years for them to dominate in the United States, but then they were very aggressive in going international. They were very successful. But I think that eventually the same thing will happen for Open Door, but they're still at the early stages. It's like Uber in 2010.
You've talked about an $82 price target. Uh, what's the basis for that, and over what time frame?
Sure, that's a 3-year price target. Although hopefully it will come sooner. We'll see. There are some similarities, I think, between Open Door and GameStop from a few years ago, where GameStop obviously had a very quick rise in the stock price because there was a lot of retail investor interest. There was a high short interest in GameStop, and there was also a high short interest at Open Door. So there are people that use options playing with Open Door. So there's the potential it could move faster. But the way that I came to my target for $82 for Open Door is that um, Open Door obviously has not historically made profits. So you can't use a price to earnings multiple. You can't even use a something like a enterprise value to EBITDA multiple. You have to use basically a price to sales multiple, like some of the early growth stocks from the dot-com era or something like that. But it doesn't really help you to look backwards with a price, a historical price to sales multiple. You really have to look forwards because and it was the same with Carvana, where things were growing so quickly. It was better to look at the forward case. So what happened with Carvana is that in 2020, after there were zero interest rates, Carvana's forward price to sales was something like 6 times next year's sales. That was the multiple. Then the problems came. They go down to $3 a share. At the low point, their forward price to sales multiple was 0.5 times next year's sales. And now they've come back out and they've shown that they're profitable. And now they've received a new rating from Wall Street, and they're now valued closer to like 5 times next year's sales today. So with Open Door, when they came public through a SPAC in 2021, and their highest price to sales multiple was 7 times. They went down to a low of 0.1 times, so they went lower than Carvana. And now they've come back, but they're only at 0.5 times. So my $82 target is, let's assume 3 years from now, it goes back to 5 times. They're supposed to do $12 billion in revenue in 2029. That's how you get to $82 by 2028.
I guess mortgage rates are very important for your investment. How much would lower rates help both the housing market and Open Door specifically?
It's very important to the housing market. Like right now, in the United States, most people get 30-year fixed rate mortgages. And right now, those are available for about 7%. At the low point, you could get a 30-year fixed rate for 2%. So it'd let you buy a more house, basically. For a monthly payment of $1,500, you can buy a more expensive house at 2% 30-year rate versus a 7% rate. So right now you have a problem where many people who got the lower rates don't have an incentive to move because they fear that they will lose their rates. And then have to move from a 2% rate into a 7% rate if they move. So if it's probably going to take not just one cut or two cuts to really unlock the mortgage market. It probably will take maybe 200 basis points of cuts to make it to take it down to 5%. I don't think we're going to go back to 2% or 3%, at least, unless things get really slow in the United States. but a 5% rate would make a big difference in terms of getting more people to be able to afford a home and want to make the decision to move from one location to another. So it's a very important point. There's a chance. I think the reason why just in the last 2 days this week that the markets have been weak is that there's new fears that maybe Jerome Powell will say tomorrow that he's still worried about inflation. He still thinks it's too hot, and therefore he has to wait longer before he cuts. But I think with all the signs are there that there's unemployment continues to go up in the United States, and so when that happens, like usually it doesn't take long before the Federal Reserve has to respond and try to help get the economy going again. So I do think it's reasonable to expect that there will be a significant number of rate cuts over the next 2 or 3 years, and that's going to very much help Open Doors business.
You've mentioned interest in AI, crypto, and real estate tech. Where do you see the most exciting opportunities right now?
So the other two opportunities I really like are there's two companies that are Bitcoin miners. So they've historically just mined Bitcoin, and they both make a lot of money now when Bitcoin is over $100,000 at doing that. But a few years ago, they realized that well, we're getting closer and closer to Satoshi's limit of 21 million Bitcoin being mined, and so even though the price is going to continue to go up, the volume of new Bitcoins mined is going down. So should we think about new businesses? And two stocks I like the most. One is called Iron, IREN. It's a company from Australia. And the second one is an American company called Cipher Mining, or CIFR is the ticker. And they are both moving into building AI data centers. So they use their knowledge of how to build an efficient data center to mine Bitcoin. They use that knowledge to start looking around the world, and especially in the United States, and buying real estate, land, where it was going to be close to very cheap energy sources, because they both made the assumption, and it's a very important assumption, that we just don't have enough energy in the world to power the data servers that are needed to deliver all of the AI services that we use today with things like ChatGPT. But the usage is just going to continue to go up, by this time next year, and then in 2 years, and then in 3 years. And so you need more and more data servers running NVIDIA Blackwell chips and then Rubin chips to power all these services. Somebody has to build them. Somebody has to buy the land. Someone has to negotiate the energy connections. And then they have to build the data centers, buy the chips, build out the servers that people like Microsoft will use, Meta will use, Oracle, who is a partner with OpenAI, will use, and Google will use. Those are the big ones. And we hear those companies, they announce on their earnings calls that they are continuing to spend more on CapEx, capital expenditures. So every quarter they seem to say, we're going to spend even $10 billion more next quarter than we spent last quarter. And then the next quarter comes, and here's another $10 billion that we're going to spend. But somebody has to actually build those data centers. And Iron and Cipher started maybe 3 years ago. So both of them, they're not just building data centers, they're building big data centers, which each will have 3 gigawatts worth of AI data centers built by this time next year. And so I think what will happen is that these bigger hyperscalers, like Microsoft, Oracle, Meta, Google, they will each start making deals with these companies to say, hey, we want to use your data center. We want to use your data center, and we will pay you $10 billion over the next 5 years or something like that to use your data center that you have already built. And so I just think that there have been some deals so far. Core Scientific just sold to CoreWeave. TeraWulf also announced a deal with Google, but both TeraWulf and CoreWeave they don't have 3 gigawatts each. They have a smaller number of powered AI data centers. So I think between now and the end of this 2025, this year, I think we will see Iron and Cypher sign some big deals, and I think it will surprise people how much money they'll be paid by these hyperscalers. So I think both Iron and Cypher in the next 5 years they have the chance to 100x themselves, especially as people realize like there's just not enough energy in the world. Anybody who has energy will be very valuable.
We wanted to ask you many more questions and hear more of your insights, but we know how busy you are. Even though our time was short, it's been a real privilege to learn from you today. Thank you so much for making the time to join us. Before we wrap up, could you share a final message for Korean investors who are getting more involved in the US stock market?
Yes, I just wanted to say that I congratulate you for having a nose for opportunities and value like Open Door. Like I said before, I think there have been more Koreans who have contacted me about their interest in Open Door than any other country in the world. And there are many countries in the world that are interested in Open Door, but the Koreans take the prize for being the most interested. So I look forward to continuing to get to know many of you, and hopefully in the new year I will have an opportunity to come to Korea and visit many of you in person on a tour.
Once again, it's been a true honor to hear from Eric Jackson of EMJ Capital. And to our viewers, thank you for watching. If you found this interview valuable, please don't forget to like, share, and subscribe. At Growth Research, we'll continue to bring you in-depth conversations with some of the best investors and entrepreneurs. We'll see you in the next episode.
Eric, can you say 감사합니다? That's how you say thank you in Korean. 감사합니다.
감사합니다.
감사합니다. 네.